Are you worried about the stability of the housing market? Picture this. The average 30-year mortgage in the United States just surged to a staggering 7.6%, the highest level since 2000. But why does this matter? In this video, we'll delve deep into the precarious state of the housing market, exploring why the looming crash could eclipse the 2008 crisis. Brace yourself as we uncover the hidden truths behind inflated prices, interest rates, and ominous economic signals. This isn't just another downturn, it's a perfect storm brewing. Stay tuned to find out why. So, without any further delay, let's get started. The illusion of stability. The housing market today presents a facade of stability, but beneath the surface lies a precarious reality. At first glance, it may seem like smooth sailing with rising home prices and low mortgage rates. However, this apparent calm masks deeper issues that threaten to unravel the market's stability. One of the primary factors contributing to this illusion is the unchecked escalation of housing prices. While it's true that home values have soared in recent years, this upward trajectory is not sustainable. The exponential growth in prices has far outpaced the rate of inflation, creating a dangerous imbalance in the market. Moreover, the surge in demand for housing has been fueled by a combination of factors, including low interest rates and speculative investment. Many buyers have been lured into the market by the promise of quick profits, driving prices to dizzying heights. However, this frenzied activity has created a bubble that is ripe for bursting. Another aspect contributing to the illusion of stability is the widespread belief that real estate is a safe and reliable investment. Historically, property has been seen as a solid asset with the potential for long-term growth. However, this perception overlooks the inherent risks and vulnerabilities of the housing market. Furthermore, the reliance on debt to finance home purchases has amplified the fragility of the market. With a significant portion of buyers relying on mortgages to fund their purchases, any increase in interest rates could spell disaster. As mortgage payments become more burdensome, homeowners may find themselves unable to meet their financial obligations, leading to a wave of defaults and foreclosures. Inflation's deceptive influence. Inflation plays a pivotal yet often overlooked role in shaping the dynamics of the housing market. While nominal price increases may seem impressive on the surface, adjusting for inflation unveils a more nuanced picture of true affordability and value. Imagine purchasing a home in the year 2000 for $200,000. At first glance, this might appear to be a prudent investment. However, when accounting for inflation, the purchasing power of that same $200,000 today would be equivalent to approximately $356,000 in 2023 dollars. This illustrates how inflation erodes the perceived gains in real estate investments over time. To accurately gauge the extent of housing market bubbles, it's essential to analyze inflation-adjusted prices. One commonly used metric for this purpose is the inflation-adjusted Case-Shiller Index, which provides a more accurate depiction of home price trends by factoring in changes in the purchasing power of the currency. When viewing housing prices through the lens of inflation-adjusted metrics, the magnitude of price increases becomes more apparent. In many cases, what initially appeared to be modest gains in nominal terms may actually represent inflated valuations when adjusted for purchasing power. Moreover, inflationary pressures can exacerbate affordability challenges for prospective home buyers. As housing prices outpace wage growth and inflation erodes the value of savings, achieving homeownership becomes increasingly elusive for many individuals and families. In essence, inflation serves as a silent force shaping the trajectory of the housing market, subtly influencing perceptions of value and affordability. Historical context from 2008 to now. To comprehend the gravity of the impending housing crash, it's crucial to examine the historical trajectory of the market, particularly in comparison to the 2008 financial crisis. The fallout from the 2008 housing crash left an indelible mark on the economy, triggering widespread foreclosures, plummeting property values, and financial turmoil. The reverberations of this crisis were felt across the globe, underscoring the interconnectedness of the housing market with broader economic stability. Following the tumultuous aftermath of 2008, policymakers implemented a slew of measures aimed at stabilizing the housing market and preventing a recurrence of similar crises. However, despite these efforts, the market has once again veered into dangerous territory with escalating risks of another catastrophic collapse. Comparing the current housing bubble to its 2008 predecessor reveals alarming parallels and concerning deviations. While some may argue that the market has undergone reforms and safeguards to mitigate risks, the underlying vulnerabilities remain largely unaddressed. One notable difference between then and now is the role of interest rates. In the aftermath of the 2008 crisis, central banks aggressively lowered interest rates to stimulate economic growth and stabilize the housing market. However, this prolonged period of ultra-low rates has inadvertently fueled a new bubble, characterized by inflated asset prices and excessive risk-taking. Moreover, the speculative fervor that fueled the housing market leading up to 2008 has once again reared its head, with investors chasing unsustainable gains and overlooking fundamental indicators of market health. In essence, while the 2008 housing crash served as a wake-up call for policymakers and investors, the lessons learned have been overshadowed by complacency and short-term thinking. Please feel free to like and subscribe if you have not already. Also, comment below with your thoughts. Let's continue. The interest rate conundrum. The dynamics of the housing market are intricately tied to interest rates, forming a delicate balance that shapes borrowing costs, affordability, and market sentiment. Understanding the nuances of interest rate fluctuations is essential for unraveling the complexities of the impending housing crash. Historically, interest rates have served as a powerful tool for central banks to influence economic activity and inflation. In the wake of the 2008 financial crisis, central banks around the world adopted accommodative monetary policies, slashing interest rates to historic lows in an effort to stimulate borrowing and spending. These ultra-low interest rates spurred a surge in demand for housing, driving up prices and fueling a speculative frenzy in real estate markets. However, this prolonged period of artificially low rates has created distortions in the housing market, leading to inflated valuations and unsustainable levels of debt. Moreover, the prospect of rising interest rates poses a significant threat to the stability of the housing market. As central banks begin to unwind their accommodative policies in response to mounting inflationary pressures, borrowing costs are expected to rise, placing downward pressure on housing prices and affordability. The Federal Reserve's signaling of impending rate hikes has already sent shockwaves through financial markets, triggering volatility and prompting investors to reassess their exposure to risk assets, including real estate. Furthermore, the interplay between interest rates and mortgage financing adds another layer of complexity to the housing market conundrum. As mortgage rates rise, the cost of home ownership increases, potentially dampening demand and exacerbating affordability challenges for prospective buyers. The ominous sign, inverted yield curves. In the realm of economic indicators, few signals carry as much weight as inverted yield curves when it comes to forecasting recessions and predicting market downturns. Understanding the significance of these inverted curves is paramount in assessing the health of the housing market and anticipating potential pitfalls. An inverted yield curve occurs when shorter-term interest rates exceed longer-term rates, reflecting market expectations of future economic weakness. This inversion is often interpreted as a harbinger of recession, as it suggests investor pessimism about long-term growth prospects. Historically, inverted yield curves have preceded almost every recession in the United States over the past century, making them a reliable predictor of economic downturns. The yield curve's predictive power lies in its ability to capture shifts in market sentiment and expectations for future interest rates. The implications of inverted yield curves for the housing market are profound. As investors anticipate an economic slowdown, they become more risk-averse, leading to decreased demand for real estate assets and downward pressure on housing prices. Moreover, inverted yield curves can exacerbate affordability challenges for home buyers by pushing up borrowing costs and mortgage rates. Higher financing costs make home ownership less attainable for many individuals and families, further dampening demand in the housing market. The recent inversion of yield curves has raised alarm bells among economists and market participants, signaling heightened risks of a looming recession. While the timing and severity of a potential downturn remain uncertain, the presence of inverted yield curves underscores the fragility of the housing market and the need for vigilance in monitoring economic indicators. The impending collapse, connecting the dots. As ominous signs continue to mount and economic indicators flash warning signals, the prospect of an impending collapse looms large over the housing market. Connecting the dots between various factors reveals a troubling picture of vulnerability and instability, underscoring the urgent need for proactive measures to mitigate risks. The convergence of inflated housing prices, rising interest rates, and ominous economic indicators paints a grim portrait of the housing market's trajectory. While each factor may seem disconnected on its own, their collective impact creates a perfect storm of impending crisis. Inflated housing prices, fueled by speculative fervor and accommodative monetary policies, have created a bubble that is ripe for bursting. The disconnect between home prices and fundamentals, exacerbated by unchecked inflation and speculative investment, has created unsustainable levels of risk in the market. Rising interest rates further exacerbate the fragility of the housing market, increasing borrowing costs and reducing affordability for prospective buyers. As central banks pivot towards tighter monetary policy in response to inflationary pressures, the risk of a market correction intensifies. Moreover, ominous economic indicators such as inverted yield curves and historical precedents point towards heightened risks of a looming recession. These signals, coupled with mounting geopolitical tensions and global economic uncertainties, cast a shadow of doubt over the housing market's stability. Connecting the dots between these various factors reveals a precarious balancing act, with the potential for catastrophic consequences if left unchecked. As stakeholders grapple with the implications of an impending collapse, proactive measures must be taken to address underlying vulnerabilities and safeguard against systemic risks. Impact on homeowners and investors. The looming housing market crash isn't just a concern for economists and policymakers. Its repercussions will reverberate throughout communities, affecting homeowners and investors alike in profound ways. For homeowners, the fallout from a housing crash can be devastating. As property values plummet and foreclosure rates soar, Many families may find themselves underwater on their mortgages, owing more than their homes are worth. This can lead to financial distress, forced relocations, and a loss of wealth accumulated over years of home ownership. Moreover, rising interest rates could spell trouble for homeowners with adjustable-rate mortgages or those looking to refinance. As monthly mortgage payments increase, the risk of default rises, putting even more pressure on struggling households. For investors, particularly those heavily invested in real estate, the implications of a housing crash are equally dire. Properties purchased with the expectation of continued appreciation could quickly lose value, eroding investment returns and potentially leading to financial ruin. Furthermore, the rental market could see significant disruption as vacancy rates rise and rental income declines. Investors reliant on rental properties as a source of income may find themselves grappling with cash flow challenges and difficulty servicing debt obligations. The ripple effects of a housing crash extend beyond individual homeowners and investors to impact broader economic sectors. Construction activity could grind to a halt, leading to job losses in the housing industry and related sectors. Consumer spending may also take a hit as households tighten their belts in response to economic uncertainty. As the specter of a housing market crash looms large, it's crucial to stay informed and prepared. The warning signs are clear and the stakes couldn't be higher. Whether you're a homeowner, investor, or simply concerned about the economy, understanding the underlying factors driving this crisis is paramount. Remember, the future of the housing market hangs in the balance, and only by facing the harsh truths can we navigate the storm ahead. Don't forget to like and subscribe for more insights into pressing economic issues. Thank you for watching, and until next time, stay vigilant.